Welcome to today's video, where we reveal a little-known but costly tax trap that can hit right after you say, "I do." Specifically, we'll break down how one spouse's general-purpose medical FSA can instantly disqualify the other spouse from contributing to an HSA, why this happens, what penalties are at stake, and how to fix it fast using your qualified life event rights. We'll move step by step, provide a clear action plan, and include a short quiz to test your understanding. Here is our agenda. First, we will uncover the hidden IRS rule that disqualifies HSA contributions when a spouse has a general-purpose medical FSA. Next, we will explain why HSA contributions become ineligible and what penalties may apply. Then, we will show you how to use your qualified life event rights to fix the issue quickly. After that, we will cover important edge cases, including limited-purpose FSAs, grace periods, and carryovers. We will also walk through how to correct excess HSA contributions if you already made them. Finally, we will test your knowledge with brief quizzes. Before we dive in, a quick disclaimer. This video is educational in nature and is not tax, legal, or benefits advice. Your employer's plan documents and administrators control what is possible, and rules can vary by plan and change over time. Therefore, always verify details with your HER or plan administrator and consult a qualified tax professional for your situation. With that said, let's proceed to the rule you need to know. Here is the core rule in plain terms. When either spouse is covered by a general-purpose medical FSA, the IRS treats both spouses as covered by that FSA. Consequently, anyone covered by a general-purpose medical FSA is not eligible to contribute to an HSA. This disqualification applies even when both spouses have separate high-deductible health plans. Therefore, if you get married and your new spouse has a general-purpose medical FSA, you must stop HSA contributions immediately to avoid penalties. Next, we will see how the qualified life event can help you fix this quickly. This timeline illustrates the sequence from marriage to resolution. First, marriage occurs at time 0. Next, within a typical 30-day window, and sometimes 60 depending on the plan, you must report the qualified life event to your employer or FSA administrator. Then, the FSA change becomes effective based on plan rules, often at the start of the next pay period or the next month. While the FSA remains general purpose, HSA contributions are not allowed. After the FSA is canceled or converted to limited purpose or post-deductible, HSA eligibility resumes. Finally, by your tax filing deadline, remove any excess HSA contributions and related earnings to avoid the 6% excise tax. Here is the fast fix using your qualified life event rights. First, on day 1 of marriage, confirm whether either spouse has a general-purpose medical FSA. If so, pause HSA contributions immediately through payroll and, if applicable, through your HSA custodian's automated deposits. Next, contact the FSA plan administrator and use your qualified life event rights to cancel the general-purpose FSA or convert it to a limited-purpose or post-deductible FSA. Then, request written confirmation of the effective date of the change. After that, resume HSA contributions only once the FSA is no longer general purpose. Finally, you may adjust contributions to catch up for the remaining months of eligibility if you wish. If you already contributed to an HSA while ineligible, the contributions are considered excess and are subject to a 6% excise tax for each year they remain in the account. To fix this, request a return of excess contributions from your HSA custodian before your tax filing deadline, including any earnings attributable to those excess amounts. You will receive tax forms from your custodian, typically forms 1099-SA for distributions and 5498-SA for contributions. Additionally, coordinate with payroll to stop future pre-tax contributions until eligibility is restored. Finally, remember that HSA eligibility is determined on the first day of each month, so reassess eligibility after the FSA change takes effect. Let's compare what disqualifies versus what preserves HSA eligibility. On the left, an HSA is disqualified by a general-purpose medical FSA that covers either spouse, by an FSA with a grace period or a carryover that can reimburse current year general medical expenses, and by a general-purpose HRA that covers the spouse's expenses. On the right, HSA eligibility is preserved when the FSA is limited purpose, meaning it only covers dental and vision, or when it is post-deductible, meaning it only pays after the IRS minimum deductible has been met. Dependent care FSAs are separate and do not impact HSA eligibility. Similarly, an HRA that is limited to dental and vision or is post-deductible does not disqualify the HSA. Here are important edge cases. First, limited purpose and post-deductible FSAs generally preserve HSA eligibility. Second, carryovers and grace periods can extend general purpose FSA coverage into the new plan year and block HSA eligibility until they are ended or converted. Third, run-out periods, which only allow submission of prior year claims, typically do not disqualify HSA eligibility if the plan does not reimburse current year expenses. Fourth, some plans automatically cover spouses, so you must confirm whether the FSA covers both spouses by default. Fifth, you generally cannot cancel an FSA retroactively. Changes are typically prospective from the qualified life event effective date. Finally, always obtain plan terms and confirmations in writing and retain them for your records. This table summarizes key deadlines and contacts. First, marriage is a qualified life event, and most plans require notification within 30 days, though some allow 60. Contact your HR or FSA administrator to cancel a general purpose FSA or convert it. Next, work with payroll to pause HSA contributions by the next pay cycle. Then, confirm the effective date of FSA termination or conversion with your FSA administrator and get it in writing. By your tax filing deadline, request a return of excess HSA contributions and earnings from your HSA custodian to avoid the 6% excise tax. Finally, maintain documentation for your records and for Form 8889 preparation. Quiz time. Question: if either spouse is covered by a general-purpose medical FSA, can the other spouse make HSA contributions? Option A: yes, as long as each spouse has their own high-deductible health plan. Option B: yes, but only up to half the annual HSA limit. Option C: no. HSA contributions are not allowed while that FSA coverage exists. Option D: yes, if contributions are post-tax. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is C. When either spouse is covered by a general-purpose medical FSA, the other spouse is treated as covered as well, which disqualifies HSA contributions until the FSA is canceled or converted. Now let's reinforce this with another quick question. Next quiz question: which FSA type generally preserves HSA eligibility? Option A: general-purpose medical FSA. Option B: limited-purpose FSA for dental and vision. Option C: FSA with a 2.5-month grace period. Option D: any FSA, as long as the balance is zero. You may pause the video now to consider the answer. We will discuss the answer in the next section of the video. The correct answer is B. A limited-purpose FSA, which only reimburses dental and vision expenses, generally preserves HSA eligibility. Post-deductible FSAs can also preserve eligibility. In contrast, general-purpose FSAs and many grace or carryover designs that reimburse current year medical expenses will typically disqualify HSA contributions. Here are the key takeaways. First, marriage can instantly disqualify HSA contributions when either spouse has a general-purpose medical FSA. Second, use qualified life event rights immediately to cancel or convert the FSA and restore HSA eligibility. Third, pause HSA contributions until the FSA is no longer general purpose, and then resume. Fourth, if you already contributed, remove excess amounts and earnings by your tax deadline to avoid the 6% excise tax. Finally, note that limited purpose and post-deductible FSAs typically preserve HSA eligibility, and dependent care FSAs do not impact HSA eligibility. Let's turn this into an actionable checklist. First, ask both employers whether there is a general-purpose medical FSA that covers spouses. Second, if the answer is yes, pause HSA contributions immediately. Third, file your qualified life event request to cancel or convert the FSA and ask about limited purpose or post-deductible options. Fourth, obtain the effective date in writing and save it in your records. Fifth, Reassess HSA eligibility on the first day of the next month, and resume contributions if eligible, adjusting amounts as needed for the remainder of the year. Finally, if you had ineligible months, request a return of excess contributions from your HSA custodian before the tax deadline. In summary, confirm FSA status on your marriage day. If a general purpose FSA is present, pause HSA contributions to avoid penalties. Use your qualified life event to cancel or convert the FSA and document the effective date. Resume contributions once eligibility returns and adjust as needed. If you contributed while ineligible, correct the excess before your tax deadline to avoid excise taxes. Next, we will wrap up with our closing message. Thank you for watching. If this video helped you avoid a costly mistake, please like the video, share it with someone who is getting married, and subscribe for more practical guidance. We would love to hear your questions and experiences in the comments, so join the conversation and let us know how you handled your FSA and HSA after marriage.